Oh, sorry about that. I think I had my mute button mistakenly on. In fact, why don't I, well, you know what, we'll just go forward. We'll go forward here just a second, folks. I want to make sure you can hear me. I hit that mistakenly with my elbow, so sorry about that, ladies and gentlemen. Okay, so I think we're good. And yeah, I think we're good. All right, everyone. Sorry about that delay, but we're going to jump in here and get back to it. Even though we missed out on some of the audio, you did see the screens. So we're going to trade like options would, like a large institution would in trading options. And for example, an insurance company might trade options in the same way that we're going to discuss. So they're going to show us how to get paid premiums and assume risk along the way. We can sell and manage time, ensure ourselves by hedging, need to be consistent and patient along the way in this process, and look at probabilities that are favorable in the long run. So we're going to look at essentially the same math and statistics that insurance companies might use when they're collecting premiums. We want the mathematical odds to be in our favor. So we're going to collect premium with these option strategies where we manage risk and reward along the way, not getting too greedy. We need help and experience to maybe give us some guidance. And as importantly, we need the correct tools, the automation to make this happen. So we have many base hits is what we're looking at. We're not swinging for the fences. So that is the goal here. And we have these short option strategies for premium collection with non-directional bullish and bearish strategies. We can target outcomes with fixed risk. So before we jump in, let's learn a couple letters of the Greek alphabet. So determining probabilities, let's look at delta. How much does the option value change with the change in the underlying index or asset? But it's also used by options traders and defined as the approximate probability of that option expiring in the money. So there's a option delta in this example of 0.25. So that means there's a 25% chance that expires in the money, and then a 75% chance it would expire worthless. So remember, delta is always moving with time decay as well as prices moving up and down. And it is not the probability of a winning trade, so keep that in mind. That's an important distinction. And then there's theta, which is sensitivity to time. Remember, options are a wasting or a decaying asset with limited life. So theta represents time decay. It's a negative number of 1 day of time decay is what that equates to. So if an option's at 10 points and theta is negative 0.05, the next day your premium would decline to 9.95, and the next day 9.90, so on and so forth. And that's just to illustrate the theta decay. So here's what it looks like on a graph. As you approach time zero, the percent of the premium remaining declines steadily for a while, but then actually the slope of the decay increases in the last 30 days or so of the option's lifespan. So Wall Street pros are using multi-leg option spreads to collect premium. That's what we're going to look at. This woman here on CNBC, I have her name mentioned later, but she says option spreads are buying and selling different contracts. It's a common way for investors to hedge risk and volatility. It's usually cheaper because you can offset your cost by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. So she's absolutely correct. So here's an example on the E-mini S&P 500. We're going to look at a call spread. You might place this if you're bearish or maybe even moderately bullish, or if you have no bias in terms of direction and maybe you think the market will be choppy And here's an example of this call spread. The red line is what you sell. So the 64.10 strike price call, you collect 4.5 points, put that in your pocket, but then you also buy, that's the blue line, the 64.30 call, you pay 2.25 in this example. And the net result is you collect 2.25 points, $112.50 minus your commissions. And that's kind of what that looks like. Just a simple call spread. And then here's a put spread, just the opposite really. Opposite scenario if you're selling that put spread, an out of the money put spread. So here's the put spread below the market that you're selling and collecting premium for. And then here's an iron condor. That's a combination of the two spreads that we just looked at, the bull put and the bear call spread. And don't get caught up in all the technical names and jargon. It's not necessary. But here's the example of you're selling this out of the money call spread. You sell an out of the money put spread. So you're collecting premium on a net basis on both sides of this transaction, on the puts and the calls. And then you can see the market kind of traded along sort of this upper range here, but stayed below the calls here that you sold. And then so after theta decay, in that example, what would have happened? Well, here's an example where right here at this point, this arrow, this is you get a signal here to close out the trade and buy it back. So you sell the trade initially, collect the money, and then to close it, you buy it back for less than what you initially received for it. And you see this blue symbol here, and we're going to show you in the demo exactly what that means. But that's the profit taking signal. And then you've got the dragonfly spread, and that's our proprietary strategy unique to us, and we originated that years ago. And it's 6 legs, not 4, like a condor, and it's really a variation on the condor. And it's a little more risk averse, and we're going to show you some examples of that in the demo as well. But here's the structure. It might look complicated at first glance, but you can see on the graph, I think it helps explain it a bit better, where you sell 4 calls, you buy 3 further out of the money calls, and then 1 closer to the money call. And then you do the same structure here with the puts. And you'll notice that, let's look at the puts here. You sell the 53.50 puts, and then you buy 1 5400 put. So that put that you buy or that you own is 50 points closer to the money compared to the 4 that you sold. And then the same with the calls. You see this one here that you buy, it's also 50 points closer to the money compared to the 4 you sold. It's not always going to be 50 points, but in this case it is. And this changes the dynamic dramatically on the risk and reward compared to a condor. So there are certain scenarios where this dragonfly structure is really going to pay off for you. And we're going to show you that. The call that you own here and the put that you own being closer to the money has also a higher delta. So it will gain in value more rapidly, which is good for you because you own it. And theta decay will not impact it as rapidly as well because it's closer to the money compared to the 4 that you sold here and here. And then these 3 calls and these 3 puts that you sell, that you buy further out of the money are there for a hedge or protection, and also to keep your margin requirement lower. So here's what happens after theta decay works its magic. So here's that same spread. You see the market kind of moved around, and then here at this point you get this profit taking signal right where that arrow is, and then you buy back the spread. So you sell it, collect the premium, and then you then buy it back later and close out the position. You buy it back for less than what you received. So it's basically like going short an asset and then you buy it back for less money. That's the whole idea. So stick around. In just a few minutes, we're going to show you how we respond to a live trade alert. This is an example of what a trade alert might look like coming into your dashboard or on your phone or via email. And then to accept that trade alert, you just touch the screen there and click accept. So it's that simple. Our technology handles the rest. And we're going to look at just a couple of unique bullish or bearish strategies too. So it's not just non-directional strategies that we're talking about. But keep in mind, if you're bullish on something, certainly there are multiple strategies, or bearish. Either way, we're going to look at that as well. And here's a couple examples. Here's what we call a bull or a bear hedge strategy. So you can sell out of the money puts and calls. And let's just look at it as an example here. I think looking at the graph is better than a bunch of words. So, okay, so this is a bull hedge. Maybe you're bullish on the index, on the S&P, for example, or in this case, this is the NASDAQ. Sorry about that. So what you would do here is you place an order to buy an out-of-the-money call spread, but simultaneously you sell an out-of-the-money put spread to help pay for it. And a lot of times you can do this for a credit or at no cost. So you can see here's the market, and now you decided to place this position, and the market starts trading. And in this example, looks like it would have done very well if you were bullish. And then same thing with the bear hedge, just the opposite or inverted position, where maybe you're bearish, and so you want to buy an out of the money put spread, but that's a debit spread, so that costs money. And how can you pay for that? Take some risk off the table in terms of the cost of the put spread. Well, you have to sell an out of the money call spread and collect premium um, for selling that call spread, and that would finance the purchase of this out of the money put spread. So that's what that would look like. Just kind of a creative way to place a trade, usually at no cost. It doesn't mean no risk, it just means no cost up front. But how do you know what strategies to employ, which markets, at what price? What's your timing in terms of your entry and your exit? How do you manage risk and profits along the way? So that's the question. It can be confusing. That's why we created ThetaTrader. These are pre-built option strategies. Our algorithm generates what we call theta trades every day that you can choose from. And then you can also respond to those one-touch responsive trade alerts, is what we call them. Those are live and integrated with your trading account here at AltaVest. So any market condition, and then automation with risk and profit tracking. And that's the color coding called the risk thermal indicator. So I am going to switch screens here. Give me just a moment. All right, you are now looking at the dashboard for ThetaTrader. This is the demo account that I use for these presentations. And your real account will look almost identical, just a few different items along the menu here. But you notice here's an active trade alert, and I'll get to that in a moment. And here are the theta trades for today. You'll notice there's a tab that's bullish or bearish or non-directional. And that applies to 3 markets: the E-mini, S&P 500, NASDAQ 100, and Russell 2000. And we'll go into detail a little later as to why we focus on those 3 markets. But really the short answer is that's where the liquidity is. That's where the volume is. So that's a benefit to be able to trade in a liquid market for the tighter spreads on execution. And then you have your short option positions here. And these are just positions I use and place during webinars. And you'll see the different color coding, and I'll show you that detail in just a second. But you have trades anywhere from 3 to 59 days till expiration here sitting on your dashboard on your open position. Any open bought positions here as well. Those are debit spreads, and these are credit spreads up here. Then here's your trading account information that's integrated directly with your AltaVest trading account. And then current quotes up here. So we looked at the Condor and the Dragonfly. So let's go ahead and jump into a couple of examples here on some theta trades for today. Here's the April end of month Iron Condor. You can see it's on the neutral tab, and this is on the E-mini S&P 500. stock index. All right, give it just a moment here to pull up today's condor for this expiration. First thing I do when you pull up this table is you look at a graph of the trade. You can see that this is the call spread that's being sold, and here's the put spread that's being sold, and then here's the current market price. And you'll notice as well, even before clicking on the trade here, you see that it gives you a brief summary of the trade. So you're selling the 51.90 puts and the 60.20 calls. And then you'll notice here, this is your profit potential at expiration on the trade. And then this is called the targeted annualized return at expiration. And that number there is really to compare one trade to another. That's why we put it there. So you have some sort of context as to what the distinction might be between one trade or another. So with that said, you'll notice there's 29 days till expiration. Here's the expiration date, settlement value, the premium, put risk, call risk, commission, cash required. Won't go through every detail. Again, that maximum profit potential. This is your targeted return on cash, and then the targeted annualized return. Now let's look at the trade here in detail. So the puts that are being sold are the 51.90 strikes. And if you wanted to adjust the strikes, you could. But I think the idea is to just let the algorithm do the work for you. And here are the calls, the 60.20 strike price calls. Then here's the put and call that's being bought as protection. Now I want to point out something here. Your cash required is just about $900 to try to make a maximum of $100. And you might think that seems like an upside down opportunity or an inverted way to trade where my maximum risk is a lot higher than my profit potential. Well, the whole key to collecting option premium, of course, is that you have theta decay working on your behalf. And let's look at the deltas. Remember, that's the probability that this option would expire in the money. So the 51.90 puts that you're selling, the delta's just about 10%. So that means there's a 90%, over a 90% probability this option that you're selling to someone else will expire out of the money. And then look at the call delta, about 6%. So now you've got just over a 94, just under a 94% probability that this call you're selling to someone else will expire out of the money. And then also I should point out that when we're placing these types of trades, we always expect to get out of them before expiration. The idea is not to hold these till expiration. And if you set up the automation, and I'll show you that in a few minutes, you'll always be out of these positions before expiration. And also all of the values and percentages and so forth are net of all commissions and fees within ThetaTrader. But you can see here it defaults to a sell, and quantity of 1 is your default. But if you want to change that, you go ahead and just change it like this. Maybe you want to do 5 of these. You can see your numbers change here. You want to leave the price alone. We'll try to get that price or better, and then we'll go ahead and simply place the order. And there, it's just that simple. That's how you place an order in ThetaTrader, and it just assumed you're filled in this demo account here. So we'll go back to the dashboard, and I want to show you the Dragonfly, and then we'll run through a back test and look at the trade alerts. Give it just a second. Okay, so we're going to jump into this Dragonfly, and here is the May end of month. And let's drill down and look at the details on that. You can see the short puts and short calls are displayed here. Your maximum profit potential is always going to be a lot higher dollar-wise compared to a condor. That's because you're selling a minimum of 4 calls and 4 puts. So here's what this looks like. So here's the current market price, and then you're selling these 4 calls here, buying 3 further out of the money, and then buying 1 call, in this case 50 points closer to the money. And then the same structure with the puts as well. And then here's the expiration date here, that purple vertical line. So taking a little bit of a deeper look here, you'll notice the cash required about 4,600, your profit potential 346, targeted return on cash and targeted annualized return. And if you compare it to a condor, those numbers are almost always going to be lower. And that's simply because if you look at the structure of this compared to a condor, that is, you have to spend money to buy this 6,100 call here in this example, and you spend money to buy this 50/25 put. So that's an extra expense, and it does reduce your maximum profit potential, but it can actually pay off in other ways down the road. So we're going to look at that in a second. But you'll notice the puts here that are being sold, similar to the condor, the deltas are below 10%. So you've got a 90.5% probability that the puts you're selling to someone else will expire out of the money. And again, you've got the calls you're selling, again, 93% something here probability that the calls you're selling will expire out of the money. So that's the whole idea. You want the math to work in your favor. You want the statistics and the long-term probabilities to work in your favor. And you can see it's a default to a sell. Maybe we'll do 3 of these. It raises our profit potential and cash required, maybe 4 of them. And then you can leave this, you're trying to collect 8.6 points or higher. And we'll go ahead and place that order just for that example. And just that simple. Okay, now I want to point out under this trading tab, there's also a trade simulator. It's like a backtesting machine, or a bit of a time machine, really. And I've loaded a couple examples here on this simulator. And we're going to jump into that here. Let me zoom back out so you can see more of the screen. All right, so this is a trade placed on January 15, kind of going backwards in time. It's a February end of month expiration for an iron condor on the E-mini S&P 500. So you can use these tools to kind of go day by day forward and see how the trade is working. And you can see these colors changing. That's the risk thermal indicator. Green means good. Yellow means slightly elevated risk, but don't do anything. And I can show you the details on how that's all defined. But you can see day by day, the P&L in the trade is turning a little bit negative. And you can see that you can just go button by button, or day by day by clicking here. Or you can go back to the beginning and use the play button. So now you can see the trade is now becoming profitable because it's just chopping around, going sideways, and theta decay is working. And then you get a profit taking signal right here with 8 days remaining, and the blue means take profits. And here's the best part of all. You don't have to watch or screen or anything. When this turns blue, you can set up the automation to close out the position for you. It'll place an order to exit that trade for you when you get a blue profit taking signal. So that's a real key to using ThetaTrader as well. But you can see here you had 5 days remaining, and then you can also use this tool and just go right to the end. You don't have to spend time just kind of going day by day like I did. I just did that to illustrate how to use this tool. So remember this here. This is on February 21st. You had a profit taking signal on that condor. So let's compare that to a dragonfly. It's the same end of month expiration, same trade. So instead of a condor, let's assume you did a condor and a dragonfly on the same day. And let's watch what happens. Same general idea. It initially goes yellow, a little bit of extra risk. The market's starting to move higher and higher, but still you have ThetaTrader telling you to do nothing. Yellow means do nothing. Look at this. You get a profit taking signal with 22 days till expiration on February 7. So you compare that to February 21st. You've got 2 weeks advance notice here on, I guess you could say, on the dragonfly versus the condor in terms of closing out that position for a profit. So you're able to take your money and move on to another trade 2 weeks earlier by doing the dragonfly in that case. So you can see how it can mature sometimes more rapidly, and that's simply because you own this call, for example, here, and it's acting a bit like a hedge. If the market were to run up stronger and stronger, doesn't mean there's no risk, but it does change the character trait of the trade. So here's another example. This is a July week 3 expiration, and it's a condor. I sort of forget what happens here. Trade goes a little negative, but still everything's green, do nothing. Starting to run higher and higher, still negative, but that's okay. So far so good. ThetaTrader says do nothing. The trade is turning slightly profitable. Now it's turning negative again because it's really starting to get closer to that upper boundary where you sold those calls. Then it turns yellow and orange. That's even more highly elevated, but still do nothing. And then it finally turns red. Too much risk, get out of the trade. This trade did not work. So, and when it turns red, you can also have that automated so that the order is placed for you to automatically close out that position. So this trade ends up being a loser. And let's compare that to the equivalent dragonfly. So if you did a dragonfly at the same time as you did this exact same trade on the condor, the July week 3 expiration, let's run that through. Look at that. You get a profit-taking signal with 3 weeks remaining in that trade till expiration. So instead of a losing position on the condor back here, the equivalent July week 3 expiration dragonfly actually ended up being a profitable position. So the dragonfly can just have completely different character traits if a market is pressuring the position. So it'll allow you to get out of a trade earlier sometimes, or it won't generate a loss when a condor might. So if that makes sense, hopefully, if you have any questions, let me know. But that's kind of the gist between the dragonfly and the condor. There's always more money to be made in a condor, but the dragonfly reduces the risk. It's a little more risk averse, and I think it has benefits in some ways versus the condor. It's not to say we don't do condors, but I just wanted to point out that distinction between the dragonfly and the condor. Now here's a bear hedge I loaded. So if you were bearish and you placed a bear hedge, here's an example going back in time earlier, a couple months ago. So you sold an out of the money call spread, and with that money you bought an out of the money put spread. And the colors have a different meaning here, so don't worry about that. I think I just wanted to point out the result here, where you end up in a really favorable position with this trade because the market, did what you wanted it to do. And had it not gone down and just gone sideways and everything went and expired, you probably still would have, ended up with probably very little loss, because I don't think you would have had to have a lot of money to make that trade initially. So that's how that works with the simulator, and that's available right here. And if you want to take a look at trades going backwards in time, this is basically the calendar that you use here. You can go back a long ways and then pick the month, and then just kind of pick the strategy, pick the market, and then you can see all the different strategies here. So now let me also point out, while that's loading, let me jump over here. Wanted to point out under the My Account section, and then I'll show you the trade alerts. We do have proprietary research to help you make some decisions along the way. There's something called TradeScope. We do it every day. And this is a general kind of a quick review of what the technicals look like, and also looking at some of the uh, economic data points on the calendar and on the horizon, some of the geopolitical events happening, monitoring the Fed and their rate cut projections and so forth. But this is a real quick look, might help get some guidance on if things are really overbought or oversold on any given day. And then we have a daily commentary that's more of a narrative and give you the current price quotes, and then you'll see what's happening in Asia, what's happening in Europe, any of the economic data for the day, and a synopsis of what happened in the stock market. And then looking ahead, what we're looking at as well. And then there's an economic calendar here too. And then there's also a help file. It's also, again, under my account, under help. And there's a glossary. So this is helpful if you want to look at the color coding for the RTI. I mentioned it. So it's all explained here. And then all the definitions for the strategies are explained here. And then also, this is really important here. So under my account, under settings, you can check here all the information you want to receive via email or via text with your trade alerts, and I'll show you that in just a second. And in fact, before I do that, why don't I show you the trade alert? So here's what happens when you receive a trade alert. It will show up on your dashboard. It will also show up on your phone and via email, but why don't we go ahead and view that? So these trade alerts can be sent really anytime during market hours. So this is selling a May week 2 S&P 500 Dragonfly spread, and this alert here, the put strikes were lowered 125 points below today's ThetaTrade model, and that's a reflection of the S&P 500's bearish trend. So we're still placing the Dragonfly, but we took the put side of it and kind of shifted it lower. And you should also know that every alert you receive is going to be specific and tailored to you and your account size and whatever positions you have in your account. So if you already had this position in your account or something very close to it, whether it be the same strikes you're selling or the exact same expiration and same market, then you would not receive the alert. And the quantities are pre-selected for you based on your account size as well. And you can always reduce the quantity. Maybe you can see it better if I zoom in here. I know if I'm watching presentations and I have to squint at the screen, you know, I always kind of talk at the screen, magnify it. So anyway, so you can always adjust the quantity down on any alert that you receive, but you cannot increase it beyond the initial amount that was distributed to you. You can't add risk to the trade, but you can lower risk. So just want to point that out. So you'll see here as you change the quantity, the premium collected changes. This is the entry price here you're trying to receive, the net premium being collected, and that's net of all commissions and everything. This is the cash required for the trade, days till expiration. You can see here the response here. It's been sent to you, and then let's see what happens if we well, if we accept it, it'll say accept next time you try to review it. Once you accept it, you can't just go back to it and keep accepting it. So that's kind of a, I guess you could say, a risk control. So we'll go ahead and accept that. And there you see it just shows up as being filled on the account. So that's how easy it is to accept a trade alert if you're looking at your dashboard. And let me point out a couple things, and then I want to run back and show you the trade alerts on the cell phone. Yeah, and keep your hands raised and comments coming. I'll get to those, everyone. Get to the comments and questions. But this is really how to look at your open and short positions at a glance on the dashboard, open bought positions. So these are all credit spreads. These are all debit spreads. But just want to point out, maybe you're really, really bearish, on the NASDAQ. You could just simply buy some put spreads and, pay money as a debit spread. You could sell some out of the money call spreads. If you're bullish on, the NASDAQ or the Russell 2000, whatever it might be. So I just want to point out, it's not just condors and dragonflies that ThetaTrader will work with, but that is a big focus because you have that probability on your side when you're collecting premium. I just wanted to point out too, you could also build your own trades from scratch with our trade builder. That's available. But I did point out earlier on the dashboard how any of the theta trades can be customized. So you can take a theta trade and use that as your starting point and move the strikes around and the values around. I don't know. I think it's kind of counterproductive. Not many people do that. A few, but I think for the most part, people enjoy ThetaTrader because of what it's intended to do, and that's be user friendly and make your life easier. And then if you want to look at your closed positions on one page, you can just go back in time, and you'll see here. Well, here's an example. There's 20 closed positions on this screen, and this is just again from random trades. So there's a total of 20. So you had 16 winners, 4 losers. Here's the net profit here. But you'll notice 18 of the trades here on the page were short positions or collecting premium, and there were 15 winners and 3 losers compared to the 2 positions that were long option strategies or debit spreads, 1 winner and 1 loser. So that sort of makes sense what we've talked about. The probabilities on the short option spreads over a long period of time are going to be much greater in your favor. And then also, I want to point out that there is a menu here for videos. So if you need help, these are instructional videos. If you want to, these are like 1 or 2 minutes each. Strategy here. There's education here. So it's all available here in ThetaTrader. So everything you need is embedded as part of ThetaTrader. All right. We're going to skip over to the next part of the presentation and answer some questions. And I do want to show you the alerts on the phone. I think for the most part, that's how people respond to the alerts. That's the feedback we get. And that makes sense. People have their phones with them often. So you don't have to be logged into your ThetaTrader account to receive the alert. Okay. So we talked about the trade alerts, and here's an example of what it looks like in your hand on your phone. These are one-touch responsive alerts, so you just touch, accept, or reject. These are integrated with your AltaVest trading account. Just touch, accept, and place the order, or you can reject it, and that's fine too. But here is what it would look like on your phone. I just did a screen capture. You're going to get a text message, and this will be a hyperlink. So we'll go ahead and just play that. You'll touch the hyperlink, and it takes you directly to the ThetaTrader alert page. Of course, you have to be logged in. And you'll notice a brief description of the trade, how many days till expiration. You get a graph of the trade. Should be kind of familiar as to what we just saw. See the quantity pre-selected for you. In this case, 9. There's your premium collected, the entry price. So you can take a look at that trade and make a decision if you'd like to accept it or reject it. And in this case, we would just touch accept that trade, and there it goes. It takes you to your today's order page, and just like that, the order's placed. So people love using those alerts. So with that said, I want to show you how you can get involved. You can become a lifetime ThetaTrader member, and you're going to receive everything we just talked about, everything you just saw, including the ThetaTrader software. That means the Theta trades, the risk thermal indicator, that's your automation for risk and profit, and then the trade simulator to be able to go backwards in time. Yearly value of over $3,500 for the ThetaTrader software, but it also includes the trade alerts. So I don't think any of you have seen trade alerts that work this way. I know I haven't, and absolutely positive, 100% positive feedback on the trade alert feature. So I think you'll love it too. Again, you just receive that alert, you touch accept, and our technology handles the rest for you. And then once you have the automation set up on your account, in fact, I think I briefly skipped that part. And well, let me go back and just show you. Let me show you how to do that. Only take a second if you don't mind. I meant to come back to that. Let's see here. Where is it? Here we go. So you go under the My Account settings here, and this is where you would check if you want to receive the daily comments, if you want to get trade alerts via email, and if you want trade alerts on your phone as well via text. And then you click Save Your Settings. Now, if you want to activate the Risk Manager, you check this box here, and this will automatically close out your short positions when they reach their profit target or risk target, whichever happens first. And you'll notice the default here is at a level of 0.5, but you could change that to 0.38 and lower your risk level, or you can customize it anywhere from 0.5 down to 0.25. Now keep in mind, if you went with something like a 0.25 risk level, the loss you take per trade will be smaller, but you'll take more frequent losses compared to, say, the default level of 50. So really it's a balancing act as to what you're most comfortable with. I just use the default level and leave it at that, and then you make sure to save the settings, and then same type of checkbox here for activating your profit directive, and then make sure to save the settings. So that's all you need to do to automate your risk and profit controls, and along with the trade alerts, it becomes a very, very user-friendly platform to use, and trading in a space that most people are not either knowledgeable about or just not don't have the right tools to do it, and that's in the e-minis and using these professional option strategies. So let me go back, pick up where I left off, show you how to get involved. Hope you don't mind that short detour. So again, we're back to the trade alerts here, and the value over $4,400 for those interactive live trade alerts. So the membership includes the ThetaTrader software, including the trade alerts valued at over $8,000. And it also includes private coaching. So this is really a key factor that makes your ThetaTrader membership almost invaluable. You have a private tutor, a private coach, a co-pilot, whatever you want to call us. We're all licensed and experienced with decades of experience. We'll do screen sharing sessions for you. Let us be your co-pilot and discuss trade strategy, review your trades, valued at least $7,500. I know of many people I've spoken to over the years that are or have spent as much as $25,000 or even $50,000 on education and trading systems. And what we're telling you is we include what you need in your ThetaTrader membership. So that includes, again, the software, the alerts, the private coach, valued at over $15,500. And I know it's a little corny when you have that extra bonus, but I couldn't resist. Keep in mind, you do get our proprietary research that's only available internally to basically us, anyone using ThetaTrader, valued at almost $3,000 with TradeScope and our daily commentary. And then you have those online tutorials available, those videos, I mentioned that, and the help file. So that's all just part of the software program. And again, it's a lifetime membership. I emphasize it because people will think, wow, it's such a great deal. It's got to be every year or something. But it is a lifetime membership, over $18,500. But of course, that would be not what we're not our rate on that. And in-person events, live events, we used to offer this at $4,000. People would sign up at the back of the room and that type of thing. And our retail price on the website, $997, but we're going to do much better than that for you. This is one payment of $597. Here's the link here, cf.altivest.com/TT, TT for trade, ThetaTrader, so remember that. That's my direct number and phone number. Take a screenshot of this if you'd like. But it's just that simple. You just fill out that one page here and click become a lifetime member, and that's all you have to do. And of course, if you want a free membership, we can do that. If you fund your account with $100,000 or more, you get a 100% rebate. If you fund your account with $25,000 and up, you get a 50% rebate. So people love to take us up on that offer. And there's a 30-day money-back guarantee. So you have no risk on your membership payment. So I encourage you to sign up, get your membership credentials, your login credentials, and you'll start receiving alerts. You can use everything in demo mode. And for whatever happens in the future, in the next month, if you change your mind, that's fine. We'll just rebate that membership. But most people that sign up stick around. So I think you really like using it. And then again, why do we trade E-minis? Well, there's a bunch of reasons according to the CME group, and I went through a few of them, but this is kind of a summary. They're liquid, they're efficient, they're cost effective. So looking at liquidity, a wide array of expirations and liquidity. And let me point out something here. The E-minis and the NASDAQ 100, so the E-mini S&P and NASDAQ 100 are driving growth in the equity options trading. And let me show you this one graph here. So average daily volume on just the E-mini S&Ps at over 1.5, 1.4 million. And that's from last year. And it's just growing like crazy. So that means you get superior execution according to the CME group, with the ES options offering a cost savings of $4 to $15 per contract. So that means your spreads on the bid offer spread there is tight. So again, deep liquidity, wide array of maturities, densely packed strikes, 100 annual expirations. You get the granularity and coverage you need. And so what exactly does that mean? So here's what it means. When our algorithm, here's the market, and when our algorithm is looking for trades to build, it needs calls and puts to find. It needs to find them. They need to be available. So here's a set of calls, here's a set of puts, and as time goes by, here's another set of calls and another set of puts, and as time goes by, you have another set of calls and puts. So with the E-minis, you have the strikes available. They exist. These farther, deeper out of the money puts and calls that we're selling. If you're trying to do this type of thing and do a dragonfly on a typical stock, it's not going to work. The volume and liquidity just isn't there. So this is also the example of a laddered position. So you don't want your strikes sitting on top of each other as time goes by. So in any case, hope that makes sense. And then also, this is where volume, price, and discovery and technical levels are in the E-mini market. So how about this? The E-mini S&P, just that one market, it's 10 times greater. The value is 10 times greater than the value across all the S&P 500 ETFs. So enormous amount of value being traded on the E-minis. And also, there's no day benefit with E-minis in futures. No pattern day trading restriction. So, if you're identified as a pattern day trader in the security side of things, you get additional regulatory scrutiny and limitations. And then if your account falls below 25 grand, you're prohibited from making further trades until you bring the balance up and so forth. So it's a bit of a conundrum to be categorized as a pattern day trader. And all it takes is if you execute 4 or more day trades within 5 business days in the same account, then the SEC is basically got you on their list. So you don't have that nonsense when you're trading with futures options. Margin is more capital efficient compared to securities. And thinking of efficiency, how about tax efficiency? You're trading the E-minis and futures options and futures with us. You get tax efficiency. The IRS treats these contracts differently. It's called Section 1256 in the IRS code. So here's an example. Won't spend a lot of time, but essentially, if you're trading a futures account, you get a 20% return. Your tax here in this example, $5,360, rate of return of 14.64%. Compared to trading individual stocks, you're saving over $2,000, and that's simply because 60% of the gains are taxed at the capital gains rate, which is typically lower than your individual income tax rate. So you get favorable tax treatment and tax efficiency when trading with futures options. And there's no itemizing each trade. You don't want to end up like this poor chap here. Thought that was a good picture to demonstrate that. But always consult your tax attorney or advisor. And IRA, yep, we can do those. We get those accounts transferred to us as well. So you have a self-directed IRA. Let us know. We can work with you there. And here's another advantage with ThetaTrader. You can do the six-legged dragonfly trade as one trade. So it's one order placed at one price. You don't leg in and have to build two separate spreads like you do when you're trading stocks. So that's a big advantage. And let's see here if there's any other. I see some comments and questions coming in, so keep them coming here, folks. I promise I'll get to them. And then also immediate access to the sophisticated option strategies compared to the retail stock option traders. She makes a good point here. Most retail stock option investors only have access to the most basic call and put option strategies. They don't have access to option spreads or other more sophisticated strategies. So remember, the professionals are not just buying options. Only the rookies buy options. And that's really the worst strategy to rely on because Theta is always working against you. And so here she is. I thought it was really some good comments she made, so I'm using them here in the webinar. The appeal for a lot of retail investors to only buy options that they're much cheaper, but your potential for profit is actually not that high. So she's just referring to the probability of success. 2021, 11% of Robinhood active users made options trades, but of that, fewer than 1% actually made multi-leg options trades. So very interesting. So it's also better, I think, to just track one or two different markets, not thousands of securities. And again, you have the efficient margin. There's a clear cost structure with what we do. There's no payment for order flow. If you're not familiar with what that is, I'll show you in just a second. And there's no margin calls either. We're trading covered option spreads. So these are not naked options. Everything is hedged. So your maximum risk is capped, and these are called covered spreads. So no unlimited risk and no margin calls. So you don't want to receive a call like that on your phone, like this poor guy here. This woman says, "Who is Margin and why does she keep calling you?" So you don't get that when you're using ThetaTrader and covered spreads. And the payment for order flow, remember, these are not securities options. Everything trades at the Globex Electronic Exchange at the CME Group, the largest futures exchange in the world. So every order is treated equally. If you trade one order, one lot, or 100 contracts or spreads, it's all the same. There's no free stock trading anyway, and that's what payment for order flow is talking about with stock options. It says how do they generate large returns here? It says, well, Citadel Securities has drawn criticism for payment for order flow. They pay brokers like Robinhood to send customer trades to Citadel to execute. So when you're placing an order, it's not your brokerage firm that's filling the order. It's at the speed of light that's being sent to a third party like Citadel. They're a market maker, and then they execute and fill the order, and it flows back to you. But they pay for that privilege to fill your order, and that's because they take the bid offer spread. So they made $7.5 billion in 2022 in their market making division. So it's a popular Stock options are popular because they generate a lot of revenue and payment for the order flow. They can make more money from options than regular stock. So that's why these companies are involved so heavily. They say it's commission free, but it's not. So it's an incentive for them to lure investors. So anyway, I don't want to go. I'm not being negative on options trading in stocks. Period. I mean, sure, you can always do that, but it's not free. I guess is the point. It just says orders are executed at prices inferior to other brokers, so it's not free. If you want someone to work for you, pay a commission. Nothing of value is truly ever free. And our rates are 5.25 round turn. That's all inclusive. If you see some other published rates like 2.25, look at the fine print, and it's going to add up once they add in all the clearing and exchange fees. That's going to add up to more than what we charge in this example. That's only per side as well. So our rates are competitive. Everyone uses ThetaTrader differently, and again, all calculations are net of trading cost. So your results will be different than everyone else's because you're going to do things differently. IRA, individual, joint, corporate, LLC, trust, we do all that. And just to kind of wrap it up, why would you consider ThetaTrader? Well, it's a non-correlated approach, low correlation to traditional investments. It can improve your diversification and lower your overall portfolio risk. And you think, well, what's the risk? Well, how about inflation? Um, since since 1971, this is the value of the dollar. Kind of crazy. This is $1 million house when we were kids. Now this is what it looks like now. That's pretty painfully true. So even Apple revenue, when adjusted for inflation, is negative from about 20. Let's see, right here, what 2021. So I bet you hadn't thought of that. In fact, I was talking to a friend of mine at church the other day, and he was talking about something in the stock market he was doing and made such and such an amount of money. And I kind of jokingly said, well, when you adjust for inflation, I think you're back to even. And he goes, oh, wow, I hadn't thought of that. So anyway, so ThetaTrader is an alternative. It's a low correlation to traditional investments. It doesn't always have to be bullish is really the point we're making. So the benefits, again, strategies for any market condition, a wide margin of error on those types of dragonfly and condor trades when you collect premium, convenience of automation, diversify and or hedge. So if you have a large portfolio, you can use these strategies to hedge your portfolio. And then the trade alerts, those one-touch responsive alerts. Again, bull bear, non-directional strategies. We're not day trading. We're not trying to always pick a direction for the next day, up or down. This is a great chart here. According to my calculations, the stock market will fluctuate today. So that's not what we're trying to do here, or even try to catch every little up and down on every 5-minute or tick chart. So a lot of these trades have a really wide margin of error, 1,450 points, for example, between those short calls and short puts on this dragonfly. We think it saves a lot of time. Here's someone talking about consuming 10 to 12 hours a day in the market. We don't have time for that. So alternatives, you can diversify, non-correlated to the benchmark like the S&P. We think you need to have something like portfolio 3 with this gray piece of the pie allocated to something like alternatives, in which ThetaTrader would qualify as, for sure. And remember too, you don't want to just sit on your long positions. Drawdowns can last decades. How about, who remembers the tech bubble? If you were unfortunate, well, the NASDAQ dropped 80%. I mean, isn't that crazy to think? And now, of course, it came back, but it took 15 years. If you were unfortunate enough to buy at the highs here in like early 2000, it took 15 years to recover to where it fell from. So diversifying, used to speculate or hedge your stock portfolio. These are unique strategies, accessible. You just touch that green button for those trade alerts, or you can accept on your dashboard right here, or you can use your email to accept as well, or of course use the phone. So we make it easy for you. Again, the alerts are pre-sized for you and your account. So again, ThetaTrader membership, it's lifetime. You get 30 days guarantee on that membership fee. You get the personal coaching as well as the software. So here's what happens as I see you signing up. You just complete that order form at this link. You'll get your login credentials. You'll get an email on how to open your account, and then you fund your account, and then you can begin trading with live money. So it's that simple. Again, the algo-driven options trades, I think it helps control your emotions. Bullish or bearish or non-directional, very flexible, go anywhere strategies. You've got that trade simulator to go backwards in time. You can have a lot of fun with that as well. So there you have it, folks. That offer is available throughout the end of this week here. And let me see if I can find any comments or questions here. Minimum account size. We suggest 25 to 50,000 as a minimum, because you see the Dragonfly strategy is about a $5,000 margin requirement. So that's why. And unfortunately, we cannot accept Canadians. Wish we could. Let's see what else is there to discuss. Let's see if I have a question here. If you have any questions, be sure to enter them. I saw people raising their hands. But you can always submit your question there as well. But I think I covered a lot of ground, so I guess no questions is, I guess it could be a good thing or a bad thing. But really, that's probably going to wrap it up, folks. I don't want to take up too much of your time. And take a screenshot here, and that link is valid. That's my direct name and or direct email, I should say, and phone number. And if there's anything else to discuss or any comments or questions, I'm looking here in the chat. No, I think we're good. So thank you for your time, everyone. We had a good crowd, and sorry for the little audio glitch earlier, but that'll wrap it up. I look forward to hearing from you, and feel free to sign up, and we'll get you started. Remember, you have that 30-day guarantee. So that'll do it for me, and have a great day. Bye-bye.